Welcome back to FinTalk, brought to you by Vermic. I'm Jawad Akhtar, your host. So today I have with me my team, my SME experts. Welcome, Andrew and Steve.
Hello.
Good to be here.
Basel. Let's talk Basel. Basel 3.1. I know you guys have been working on it since the CP's come out, so there's a lot to cover. In December, we got the first part of the near final rules, near final rules, which covered largely market risk, CVA, op risk, and some other small parts. There wasn't much divergence from the CP, but Steve, I'll come to you to tell us what we saw in the CP, in the policy statement, sorry.
So for market risk, not a lot of change at all, really. So it's just sticking with the original three new approaches: simplified, standardised, advanced standardised, and internal modelled. There's some clarifications around what should be in the trading book and non-trading book, lists of transactions types that should be adhered to, and if not, you have to ask for permission to deviate. There's some constraints around internal hedges across books and across this CVA as well. So if you wanted to use internal hedging, then you'd have to do an exact external hedging match. And if you wanted to use internal hedging, there's a capital add-on that would be exactly the equivalent of the capital reduction that you would see by doing the internal hedging. So,
what else we've seen as well is around transitional provisions. The time frame is shortened to, I think the CP said 5 years, and now it's down to 4.5. So we're seeing issues around that, or the new products that firms now need to start capturing.
So for transitional provisions, the main change was for CVA. So on CVA, whereas before there was there's some legacy excluded trades, as they call them. So there was just the option to exclude the trades from the outset or include them. Now there's a transitional provision approach as well, where they're allowing the transition of the trades to be included, but only on a sort of scaled basis. So they've introduced a discount scalar calculation, and for the discount scalar, there's a weighting cap that will be applied. So in the first year, it's 50%. And it goes up to 90% in 2029 before it disappears completely. So yeah, they're allowing an extra approach now, just to keep the firms happy. They wasn't happy with just having excluded completely or included completely. So there's this third option now.
Yeah, and there's a good point that you raised about making sure that firms capture that extra trades. Now they have to, where previously were excluded, now it needs to be included, but there's a scalar that needs to be factored in, so something to look out for. So Andrew, I'll move on to you. I know you're still looking at the draft rules. So far, what have you identified as new data points?
My initial assessment of the consultation paper, I've seen how that impacts on our current product, and I've identified about 30 new client data fields, and of course that number is depending on what type of products that the firm is doing. So if you're not doing mortgages and you're not doing retail banking, then I would say that number is significantly reduced.
We saw the CP come out, we saw the policy statement, which was more of a confirmation of the responses, confirmation of the CP, so there wasn't really much that came out of it. Nothing drastic. The second part of the final rules, near final rules that we'll get, were obviously the most responded to, and there was a lot of, you just see some of the stuff on the UK Finance, or the responses that they sent back to that. So it's kind of makes sense that those have come in later, and there's been a lot more reflection on those. Do you see stuff that you've looked at so far in the CP that you may think, oh, this could change? Obviously, this is still speculation. We don't know what the final rules will say, but it's in terms of your experience and your understanding. Or to add to that, is there clarity that you would expect to see from those as well?
Well, in terms of changes and how significant those changes are going to be, it's a finger in the air. Based on what the PRI did on part 1, they recognized and acknowledged the feedback on the CP, but weren't minded to change too much of it. A lot of the feedback on the UK finance, for example, talks about that there should be changes to the transitional provisions, for example, or optionality, which has not been included, whereas it is under BIS, and a sense that UK firms going forward would not be competing on a level playing field. So those are the kind of areas I would be expecting to see changes.
Steve, any points from you?
From what I've touched on, the market risk and the CVA, we've had the feedback from the consultation paper with the policy statements been released as a near final. The only reason it's near final is because they've still got to go through some legal procedure of the HM Treasury revoking the parts of the CRR. That's the only reason it's near final rather than final. So it looks like it is going to be pretty much as has already been published. So I can't see a lot changing now.
Yeah, we're seeing that when we've had discussions with industry, is to say, yes, we're seeing all these new approaches, especially around market risk at the moment, but firms are still reluctant to move on to those new versions of doing it, or stay on the ones that they know better, especially if it's not going to give them a massive amount of capital gains. I suppose that's the carrot that dangles, right? If there's huge capital gains to be made from those approaches, do you then consider them moving on to that? Because I think you don't need to apply for permission. One of them, the advanced one needs permission.
Yeah, so the modelled type calculations you need permission to use. So yeah, there's that payoff. You're going to get some capital gain out of it, but there's going to be a lot of work involved in setting it up in the first place. So is it worth doing? So yeah.
Better the devil you know then.
It could be for a lot of banks, yeah.
Throw this in the mix though. We've got another regulation, strong and simple. Well, now SDDT. With all this changing, and we saw the first rule drop again in December. Again, nothing major came out of that. So we saw that the uptake was not significant from firms. I think a lot of them are waiting on the new capital rules to drop to understand the full impacts of it. We saw some minor changes that we see in templates being removed, some naming things happening around that, and that will happen from June. But your thoughts on the strong and simple regime?
Yeah, I think you're right. There's a bit of a waiting game there because the final capital rules have not been released. I think that's due to be published in Q2 2024, so not far away. In the meantime, there are a few minor changes that banks can apply if they are SDDTs. The NSFR, there's a new retail ratio, retail deposit ratio that so if they qualify by the retail deposit ratio calculation, they don't have to report the NSFR at all, which is a change from when they introduced the NSFR. They introduced it in two flavours, sort of regular reporting and simplified reporting. There was two separate templates for the simplified reporting. They're being done away with completely now, so they won't exist. And now it's just a case of you either report the NSFR or you don't.
Mm. There's a lot of work goes into actually just working out your RDR.
So it should be fairly easy for anyone that's doing ALMM reporting anyway. The C68 return captures the retail deposits and other deposits. So in total, you'll have your total funding, total liabilities there, and your retail liabilities there. So you just use the figures off of that to calculate your retail deposit ratio. So it should be a simple calculation. And you touch on the AMM as well. Is that they've clarified that the C68 is now going to be all liabilities, not just there was a threshold there before, only greater than 1% of
1%
threshold. So they're removing that, and they're also removing 4 of the 5 remaining templates. So C67, C69, 70, and 71 are not reported at all by SDDT.
A relief for some people.
Should make life a bit easier.
Yeah. We've obviously discussed Basel at length and in some detail. There's some areas that we've identified, let's say, obviously property being one of them, the multiple approaches for market risk, CVA, standard approach, and then ratings. Ratings have been a big topic of discussion with numerous people from the industry as well. So, what's your takeaways on those? Are there things, again, of areas of concern or clarity that we're waiting to hear or see from the regulator?
A lot of our clients, aren't they? They are asking the questions about due diligence and the impact on using external credit rating agencies. The word due diligence pops up in the CP 35 times. There's a big push, aligning with Basel, over-reliance in the past on using ratings. If people recall that initially the BCBS wanted to move away from external ratings altogether, I think that hit a brick wall. So they've kind of rode back on that. So instead they're saying, firms need to implement robust internal processes to be able to identify the risk characteristics of the exposures. And that due diligence is implemented in 2 ways. It says, first is, as I said, that you be able to identify the risk, whether it's rated or unrated, the counterparty. And that assessment needs to take place at a minimum of annual. And the second point, it goes on to say that the UK Finance, as part of their response, have identified this as an issue for smaller firms, and are asking the parade to say, what can be done, because it's a big burden on these smaller firms to be able to carry out such an assessment. So we're watching the space as to what, if anything, the PRA proposed to do in relation to having to carry out this due diligence.
Yeah, the fact that it said once a year, some firms it'd be when they do the credit application, they do the risk committee sign off and that's it. But it's not a once and done activity, because if you know your clients better than, or your customers better than anyone else. So if you know something's happened, then there's got to be a case. It is a question a lot of people are asking. What happens? Clarity from the regulator would be would help, and be able to then put robust framework, as they said, into the whole process again. Takes time. It's not going to happen overnight.
I guess you would suggest that the idea behind this is that they're saying is, in the PRA saying that this framework that you need to implement will not be reviewed as part of the S3EP for now.
Yeah,
but watch the space, and
but you're seeing that a lot. You say that on the S3EP side, but we look at it from we take the other angle from the FCA point of view. There's been a huge flurry of AML activities and KYCs and stuff like that. So that the reviews from that side will come, and it eventually will have to be part of, because this is what they say, robust framework. So you've got to have it as part of your governance, your controls. That will all clarity is what at some point it will come. We'll have
Some of the
to.
ratings you'd expect, and say, right, now we're giving you fair warning. You've had a number of years to get this framework in place, and another big concern by some of our firms has been the new standardized credit risk assessment, the SCRA, and the amount of due diligence that they have to do in respect to unrated institutions. And for those who are not familiar yet, I'd like to think everyone's familiar by now, but there's a grading. There's an A, B, C grading. Although once you read a bit further on, there's also an A plus rating if your capital is significantly higher than the threshold to get an A. And a lot of our firms have been saying that, how we're going to do this. And obviously, it depends on how broad your portfolio is, geographic spread of your portfolio. But to go out and try and capture this information, it would be a big ask. I mean, fortunately, the agencies like Fitch are offering a solution. So if there's anyone out there who's panicking, you can buy a third-party solution for this. And on unrated corporates, you have to apply for permission to have the risk-sensitive approach anyway, and that's based on having this robust framework in place. So if you don't have that, there's the risk-neutral approach. You're going to get the risk weight of 100%.
Yeah. The ratings have been a big question. Every time we've spoken to clients, or especially when we've discussed, the ratings has always been an area of concern. So I think clarity around that there's too many questions, too many open questions for our liking. So to get some answers, because in some cases, there was recently spoke to someone about talking about there's a government rating floor that you can use. So in that instance, some cases you'd be better off rather than having 150% based on the government rating. You would have 100%. So there's still some areas that I think need to be clarified. But there's a government floor, isn't there?
Because they're using this, because they're basing it on the
sovereign rating,
on the CQS or the sovereign rating.
Yeah.
So at the moment, you could get 20% as between 20 and 150%.
Yeah. So
if you're basing on the rating of the sovereign.
So if you have 100,
so potentially
sovereign rating of 150%.
Exactly, they're saying
you
that
can then gain.
Yeah, exactly. If you're based in an area where the sovereign is going to have a poor risk weighting, there's potential upside to using this methodology to get a lower risk weighting on those institutions. Correct.
And that's significant.
Can be.
Right?
Yes.
Yeah, from 150
potential
from 150% to 100%.
Down to
50% saving. That's huge.
40 or 30% potentially.
So lastly, advice for firms. Advice for firms that haven't started this or waiting for June's final paper to come out and they have the whole picture. Or even firms that are waiting on the S3EP8 paper to come out. What advice would you be giving to firms now?
Personally, I would say don't wait. If you haven't started, I would suggest you hurry up. There's a lot of changes in credit risk. Like I said, it depends on what kind of products and services you're providing. But if we just talk about pure exposure classes and risk weight changes, there is a lot. They're not that technical. So I wouldn't be panicking per se, but it's just the breadth of changes is the biggest change in the industry for 10 years. I worked on the counterparty credit risk piece a few years ago, data point model 3.0 with Saka. It was very discreet, that piece. Okay, it was a new method for starters. I think that had even more data points than I'm suggesting are required for just a standardized approach to credit risk. But that took a good 9 months of development work. Fortunately, we've got an extra 6 months buffer. If you haven't started yet, that's very useful to have in your back pocket.
Yeah, absolutely. Yeah, just the same, really. I mean, the policy statement's already given all the rules around market risk, CVA, operational risk, some Pillar 2 disclosures stuff. So that should definitely have been started, knowing that there's more to come yet. So there's definitely the work should have been started by now.
Gents, thank you so much.
Pleasure.
Thank you, guys.
Thanks, Jawad.